Us from the management, Mr. Chintan Shah, Managing Director, and Mr. Mahesh Tanna, Chief Financial Officer. So without further delay, I would now like to hand over the floor to Mr. Chintan Shah for his opening comments. Thank you, and over to you, sir.
Thank you, Rushabh. Good afternoon, everyone. We heartily welcome you all to the maiden earnings call of Tatva Chintan Pharma Chem Limited. First of all, I would hope that you and all your family members are safe and keeping well. During this COVID pandemic times, I am sure you all are taking the necessary precautions to keep safe. At Tatva Chintan, we have been maintaining the utmost hygiene norms and following all governmental regulations in all our facilities, and well-being is paramount. Now on to business updates. As you all are aware, this is our first call for our IPO in July 21. Our IPO was oversubscribed more than 182 times, a result of investor support and confidence in the company. We at Tatva Chintan are always on the lookout for opportunities to take the company to next level, while maintaining a clear emphasis on long-term development with sustainable, safe and green chemistry, with strong focus on our R&D capabilities. It's a source of pride to see our employees' devotion and dedication to serving our stakeholders in these trying times. I am grateful to our team, our customers, our board of directors, and all our well-wishers for putting their confidence and believing in us. For the benefit of new investors on the conference call, I will provide a quick overview of our company, our product facilities, and our long-term strategies for the company. Furthermore, Mr. Mahesh Tanna, our CFO, will join me today to discuss the financial performance of the company. We are a manufacturer of specialty chemicals having 4 product categories. We manufacture a broad range of structure directing agents. Our company is the largest and only commercial manufacturer of SDAs for zeolites in India and the second largest globally. Zeolites have varied applications including as catalyst as well as absorbents. Zeolites have been proven to be active for the selective catalytic reduction, which is currently considered as one of the most preferred technologies for emission control in automotive and other applications. We are one of the largest producers of PTCs in India, phase transfer catalyst, as well as we are one of the leading manufacturers across the globe. We are the only manufacturer of electrolyte salts for supercapacitor batteries in India. Supercapacitor batteries have varied applications in high energy storage devices with applications into hybrid EV vehicles, solar energy storage devices, etc. We also make pharmaceutical and agrochemical intermediates and other specialty chemicals, which also includes glynes, which we are the only commercial manufacturer in India. We believe that our extensive manufacturing capacities, consistent growth initiatives, experienced management, global footprint, and high quality products distinguish us as a trustworthy provider of niche products. Now coming to our manufacturing facilities, our company operates through 2 different manufacturing facilities located at Ankleshwar and Dahej. The Ankleshwar manufacturing facility and Dahej facility, which were established in 1996 and 2007 respectively. In addition, we continuously strive to improve our processes and infrastructure to help reduce our impact on environment. In this regard, we undertake various green chemistries processes such as electrolysis. Also, our Ankleshwar facility has been converted to zero liquid discharge facility in 2020. Our green chemistry is based on the principles of clean chemistry, minimum requirement of auxiliary substances, minimum waste and byproducts, and also safe chemistries. I would now like to talk briefly about our R&D and testings. We have a dedicated R&D facility that is recognized by the Department of Scientific and Industrial Research, DSIR, which is a Government of India institute. This facility is located at Vadodara in Gujarat with a state-of-the-art research and development infrastructure. Our R&D efforts are mainly focused on development of new products, improvement of our existing production processes, adoption of advanced production technologies, and improvement of quality of our existing products. We believe that these capabilities enable us to explore, among others, green and continuous flow chemistry processes, which may give us a competitive edge in the future. Of the products developed in last 10 years, 85 products have been successfully commercialized so far. We serve clients in India and also export to over 25 countries including United States of America, China, Germany, Japan, South Africa, and UK. Additionally, we have two wholly owned subsidiaries in USA and Europe to facilitate our international operations. Our product portfolio's diverse applications have enabled us to develop a large client base across a variety of industry segments. Now, where do we go from here? I think we are well positioned to exploit the widespread growth opportunities, especially in the areas of green chemistry and environmental control. Some steps we think are our top priorities in coming few years, which are, while we plan to continue strengthening our current production facilities and portfolio, we intend to diversify further into products with the potential for high growth and higher profitability. We plan to invest approximately INR 239 million into further expanding our R&D capabilities at Vadodara from the IPO proceeds. We are aiming to identify and implement cutting-edge technologies for process and product development, where we are deploying electrolysis and continuous flow chemistries, with the goal of increasing productivity, quality, cost efficiency, as well as adding newer products into portfolio with the aim to promote green and safe chemistries. We are a niche chemical supplier to a number of our clients and have developed a reputation as a preferred supplier over time. Our long-term goal is to leverage these partnerships by maximizing cross-selling opportunities presented by this diverse product range and a broad customer base. We have already kicked off capacity expansion plans at our Dahej facility on the existing available land. We intend to invest approximately INR 1,470 million from IPO proceeds for this purpose. We expect this new facility to be available by Q4 of next year. This concludes my planned remarks, and now I would like to hand over the call to Mr. Mahesh Tanna, our CFO, to take us through the financials before we open the floor for Q&A. Thank you all.
Thank you, Mr. Shah. Good afternoon, everyone. I would like to briefly touch upon the key performance highlights for the quarter ended June 21, and then we'll open the floor for the question and answers. On the revenue side, Q1FY22 total revenue at INR 1098 million versus INR 517 million in Q1FY21, a growth of 102.38% on year-on basis and almost flat on quarter-on-quarter basis. Looking at the EBITDA, Q1FY21 EBITDA, including other income, at INR 288.01 million versus INR 105.30 million in Q1FY21, growth of 173.96% on year-on-year basis and growth of 6.44% on quarter-on-quarter basis. Q1FY22 EBITDA margin at 26.23% versus 20.33% in Q1FY21 and 24.32% in Q4FY21. Despite the challenging environment, we have delivered our performance. Margin of the company have expanded by 590 basis point on year-on-year basis and 191 basis point on quarter-on-quarter basis. Now coming to the profit after tax, Q1FY22 PAT at INR 231.46 million versus INR 67.10 million in Q1FY21, a growth of 244.95% on year-on-year basis and 9.6% on quarter-on-quarter basis. This resulted in the earnings per share being at INR 11.52 during Q1FY22 versus INR 3.34 in Q1FY21, which is a 244.91% increase year-on-year. We have got listed on 29th of July 2021 and subsequently we got IPO funds for our capex. We have already kicked off the excavation work at the project site and started issuing work orders. mobilizing resources and will accelerate work in coming days. As on date, we have not yet utilized funds from IPO process for CapEx. That concludes the update on financial, and we'll now open the discussion for Q&A.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star then 1. The first question is from the line of Nav Bharadwaj from Anand Rathi. Please go ahead.
Ladies and gentlemen, congratulations on a great set of numbers. My key question would be, in these troubled times where most of the companies are facing raw material pricing pressures, how have we managed, to increase our margins? And secondly would be that as we are majorly an export-oriented company, what is the situation in terms of packaging and shipping and moving our product abroad in these troubled times that most of the companies are facing when it comes to shipping?
No. Yeah. Can you repeat the question? Unfortunately, I could not able to hear your question properly.
No worries, sir. So my question was that what is the impact of how are we managing our raw material prices while most of the companies are facing gross margin pressures? We've managed to increase our margins this quarter. And secondly, are we facing any problems when it comes to shipping our products? And is there any, because we are an export-oriented company, and based on the scenario that we are seeing in terms of the unavailability of containers and rising costs of containers, are we facing any challenging environments over there?
Right. I'm Chintan Shah. I'm taking this question. So in terms of, we are fortunate that most of the raw materials that we are using have remained more or less stable. Also in the past, we have instances when raw material prices had been fluctuating, but by virtue of the products that we are into and based on our long relationships with the customer, we were fortunate enough to pass on certain price increases to the customers as well. Now coming to your point of logistics, yes, that's definitely a big challenge in these days. In terms of managing our raw material availability so that we can meet with the demand schedules from the customer, we basically are maintaining quite a healthy pipeline of inventory. So this helps us to.
Excuse me, this is the operator. Participants, the line for the management has dropped. Please stay connected while we reconnect the management. Ladies and gentlemen, thank you for patiently waiting. The line is reconnected. So we have Nav Bharadwaj on the line with us.
Yeah, really sorry about this call drop, but fortunately we were able to reconnect quickly. So as I was saying that to manage this challenge, we are maintaining quite a healthy pipeline of raw materials as well as certain stages of finished products as well, so that we are able to meet the desired timelines given by the customer. Also, as you know, we have 2 overseas subsidiaries. So our key market areas, US, Europe, we try to maintain an emergency inventory stock for the key customers. So this typically helps in case of any kind of delay that we perceive. We are able to cater to those delays from our warehousing locations. And yes, of course, in terms of managing the dispatch schedules, so because it's definitely a severe scarcity in terms of containers availability of shipping line schedules, because we have a defined dispatch schedule quite in advance. So basically, we try to get our bookings at least 3 or 4 weeks in advance wherever it is possible, so that we are not getting issues in terms of maintaining those dispatch schedules. So fortunately, yes, we have faced some issues, but not in a big way.
That's great to hear, sir. So does this we had a good quarter, and this is X of any capacity expansion that we have done. So is this assumption correct that our, be it our EBITDA or our PAT, is this maintainable run rate?
Basically, we are, as you know, we are into 4 different product segments, and it's a broad portfolio of products within each individual segment. So defining individually, product margins are definitely different among the products. So there may be certain variations at times when you have a different product mix that you sell quarter-on-quarter basis, but more or less we are pretty much confident that we will be able to maintain a healthy EBITDA margins.
Fair enough. Thank you so much, and all the best going ahead.
Thank you.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Pawan Kumar, an investor. Please go ahead.
Hello.
Yes, sir.
Sir, I want to know regarding super capacity battery, sir. What is your future plan?
Super capacitor batteries, we are manufacturing the electrolyte salts for the super capacitor batteries. So these are basically, you can say that we are manufacturing the heart of those batteries, right? So this is the most important part of the battery material. As you are aware, probably it seems you are pretty much aware that supercapacitor batteries have variety of applications that are coming up. So currently you have successful applications into automotives, regular automotive cars for the start and stop function, as well as you have already existing commercial applications into hybrid EV vehicles, as well as a very strong upcoming demand in terms of applications into solar energy storage devices. So supercapacitors are nothing but high energy storage devices. So we foresee, that this is a segment which has a very good potential for future growth.
Sir, but your revenue from that is only 1 or 2%, right?
Yeah, so this is basically a new segment. The commercial applications are just beginning to be explored and deployed. So this is kind of an initial phase of the technology adoption, and going forward we may see some interesting times to come.
Thank you, sir.
Thank you. Participants who would like to ask questions, please press star, then 1. The next question is from the line of Saurabh from Asian Market Securities. Please go ahead.
Thank you for the opportunity. So if you could give us the breakup in terms of revenue from SDA, PTC and your other segments for Q1/22 versus the last year same quarter.
Mahesh here. So this quarter our SDA has contributed around 52%. And that has actually also contributed around 41% in FY21. PTC has contributed around 21.5%, and for FY21 PTC contribution was around 27.5%. Electrolyte salts has a 1% contribution during this quarter as against the 1% for FY21. And PSC has a 25% contribution during this quarter versus the annually 31%.
Okay. And sir, I just wanted to understand better in terms of this cyclicality. Is there any quarter where we see a better growth or better revenue on the quarterly basis?
No, see, basically, it all depends on how the customer schedule their production campaigns. So based on that, there is definitely possibilities of having variety or change in terms of product mix that we sell on quarter basis. But there is no impact in terms of being seasonal or something like that. It is purely based on how customers plan their production campaigns, and based on that we are able to sell particular products from particular segments.
Okay. And so for if if you look at the percentage growth in HBS is definitely much better in this quarter. So how should we look in terms of for the full year, and how is the order book position?
So see, if you are aware, the applications of SDAs are going into manufacturing of specific zeolites, and this application goes into primarily there are two segments which we are catering to. One is into manufacturing of refining catalyst, and another is where we are selling into emission controls. So this current BS6 emissions, what we talk about. So because of these applications into kind of continuous flow chemistry, when you talk of refining catalyst or chemical catalyst, and when you talk of emission control, so better environment and things like that. So going forward, we see this it has a good future, because the world over, you see most of the governments are pressurizing on going towards better environmental control. So these products typically should see a good demand in coming years as well.
Okay. Thank you.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Jagveer Singh from Shade Capital. Please go ahead.
Yeah, sir, congratulations for the good set of numbers.
Thank you.
I just want to understand where we see our company in the next, say, 3 or 4 years or 3 or 5 years. And what is the impact of China plus one theory in our company?
See, in terms of seeing our company over next 3 to 5 years, I would say we are positioning ourselves to be a super specialty manufacturer, so super specialty chemical manufacturer. So if you see our product range, in terms of SDAs, we are the sole manufacturer in India. In terms of electrolyte salts for supercapacitors, we are again the sole manufacturers in India. Even the glynes, which is a specialty chemical having applications as solvent, again we are the sole manufacturer, commercial manufacturer in India. So this is how we intend to position ourselves to be into chemistries which are sustainable, which are green chemistries, which are predominantly R&D driven, where you may find it difficult to see competition creeping in. So this is how we intend to position ourselves into niche chemistries as well as niche product areas. And in terms of China plus one policy, your question, yes, so our pharma and agro intermediate segment, the last segment where we are into, this primarily has come into existence because of the China plus one policy. So our existing customers, the large pharma and agro customers predominantly, knowing our R&D capabilities, had approached us point in time and given us these opportunities which we were able to successfully cater to. So this whole segment is basically thankful to the China plus one policy, which is now typically contributing about 25 to 30% of our revenue. And we see these kind of opportunities coming our way much frequently than we would have anticipated in earlier years.
So in terms of number, any target, internal target for the next 3 years?
No, we are seeing a good product. See, basically the product portfolio is good. The areas where we are into is also very niche and quite fast growing. So I would not be able to put up exact numbers, but we see a good growth over the next years.
Because we had a super growth in the last 3 years. So I just want to understand, can we continue with this trend?
So, Mahesh here. So, if you look at our expansion plan, so, we are seeing some opportunities in our current product portfolio. So, we are expanding our capacities so that, we can meet the future demand. So, obviously, there is a growth and we are actually targeting to achieve the potential growth available to us. So, definitely, we are going for CapEx.
Okay. Thank you, man. Thank you very much, sir. This is from my side.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah. Hi, sir. Good evening. Thanks for the opportunity. Sir, if I refer your opening remarks, you did mention, CapEx there for existing products as well as the newer ones. Just trying to understand the newer opportunity better. How much time does it typically take for us to get a product approval for the newer ones and, accordingly commercialize and scale up the operations there?
So, Ankur, by virtue of the products that we are into, these are high purity substances, very special applications. The end markets are super sensitive. So because of that, the entry barriers are very strong. So anything that we develop today typically takes about anywhere between 2 to 6 years, or probably sometimes even 7 years to go into full scale commercialization. So this may happen in steps, right from sampling to pilot scaling to a production campaign and then to a final commercial production campaign, which may end up anywhere between 2 to 6 years of a time frame. So yes, of course, the product entry barrier is very strong. So anything that comes into acceptance levels is also taking a lot of time. But I think this is simultaneously also a benefit for us because the same issues would be faced by any upcoming competition, if any, would have to undergo a similar process. So nothing can come into competition overnight.
Sure, sir. And will it be fair to assume that there will already be a work in progress product on which we would have done our R&D, historically, and probably those approvals are expected over the next coming years?
Yes. So that is an ongoing process. We have basically, if you see, our R&D has 3 verticals where we work through. One is a normal organic synthesis, which is a typical organic synthesis lab. Then where we do a lot of phase transfer catalyst and pharma and agro intermediates applications. Then we have another lab where we do electrodialysis, where we typically end up doing a lot of structure directing agents and possible new organic molecules, which we can convert from conventional chemistries to electrolytic chemistry, which is of course a green chemistry. And the third and the most recent vertical that we have since about last 1.5 to 2 years is department where we are focusing on developing green chemistry, continuous flow chemistry processes. So we do have products in pipeline in all the 3 verticals. There are certain products which have already been supplied in terms of samples. Certain products have been pilot. Certain products are into advanced stage of production trials. So yes, we are in queue with a lot of opportunities going forward here.
Sure, sir. Sir, next question on our contracts with the customer. While you did mention that raw materials were pretty benign for us in the last quarter, and there was no significant impact on the margin. How are the contracts termed? Is it the proportion of long term, short term, and the pass through of raw material inflation, if any?
Right. So basically, the way the major customers that we are working with is functioning not on actual contract basis, but most of this major part of our business works in terms of annual forecast system. So typically, a customer indicates this is the potential volume that they would buy for this year and probably the next year as well. So typically, a 1 or 2 year forecast is being given, and this is basically being given to ensure. Because see, the products where we are into, there are very few global manufacturers as well. So this kind of forecasting system has been designed so that we can keep ourselves updated in terms of our production capabilities, or wherever we may foresee a shortfall, we can take adequate actions well in advance. So we don't have any such long-term contracts or stuff like that, but it is based on forecast systems that we clearly understand what potential demands would be in this year and probably the next year as well. So
sure,
we had so again, to answer the later part of your question, we had instances last year when there were, because of COVID times, when the COVID onset happened, there were a lot of products which vanished because of supply issues, and there were drastic impacts on raw material pricing as well. Availabilities were issued. So we were fortunate enough by way of our relationships with customer, or probably the way we have shown transparency to these customers when we were in a benefit mode. we have passed on those benefits to customers in the past. And similarly, when we were in a troubled time, customers also equally supported us by absorbing those kind of raw material cost increase. So that is the reason probably why we could even have a good last year when everyone practically was struggling in terms of margins.
Sure, sir. That's helpful. And just one follow-up to the earlier one. For the newer products that we are doing in and for the existing portfolio that we have, how much is more, cross-selling led, which is, basically existing customers, we are selling more products or the newer products are being made, for those clients? And how much of it will be largely for the newer set of clients and customers for whom we would have gone for a product approval, etc.?
I would say 75% of the new product development campaign that is being carried out day in, day out is probably for the existing set of customers. So it doesn't mean that, let us say, for example, a customer of SDA uses an X product, and in future they intend probably to use a Y product. So those kind of R&D opportunities come to us. The developmental part of futuristic products also come to us. So I would say 75 for the existing customers and probably 25 to tap the unknown territories or the unknown customers.
Sure, sir. That's very helpful. Thank you and all the best.
Thank you.
Thank you. Participants, to ask a question, please press star, then 1. The next question is from the line of Archit Joshi from Dolat Capital. Please go ahead.
Thanks, sir. Thanks for the opportunity. Sir, my question is largely on the FDA side of the business. We do appreciate the fact that we have a decent bit of R&D muscle and we are trying to introduce new products, and the growth in SDA could largely be more than the other segments that we have. I was just trying to understand on a very qualitative basis as to on the SDA side, how are we planning to grow higher than the industry, since we have mentioned in the DRHP also that it's a largely concentrated market. So what kind of marketing strength, business development strength would be required? And how are you seeing this business grow maybe on a 3-year to 5-year CAGR basis? Thank you.
Right. So see, if you see these kind of technologies where the SDA deployment happens, so the global companies where most of this new developmental work happens is typically in the geographies of US and Europe. So these are the defining geographies from where these technologies are arising. So basically to have an advantage, or let us say not to have a disadvantage in those geographies, we have established our wholly owned subsidiaries in US as well as in Europe, and where both these locations we have very well experienced people taking care of our marketing and presenting Tatva Chintan in front of the customers. So probably this has shown extremely good results. You can see the growth in terms of SDA that has happened in last 3.5 years of time frame. And the beauty of this whole part is, it took us 2.5 years to establish that confidence with the customer, because since we were a new supplier at that time, that confidence had to be built, which eventually we could build up a good level of confidence with these customers in terms of supplyability, in terms of consistent quality, packaging and logistics, and maintaining stocks at various locations and meeting their delivery schedules. Because of this consistent delivery of excellent services and quality of the product, and also meeting with their pricing part also. So you need to be competitive at the end of the day. So because of all these virtues, the beauty is that now we have started getting invitations to participate in the development products for the future demands. The next future SDAs, what would be they like? The customers are doing a lot of R&D work in terms of applications into automotives or into catalyst applications or refining catalyst applications or chemical catalyst applications. So these kind of newer molecules are coming by our way, where we are able to deploy our R&D capabilities and start to offer our such services. And once you have this opportunity, the the most important benefit that you derive is they have done a development using your product. So the first opportunity when it comes in terms of commercialization would definitely come our way. So this is something very important development that has happened over last 1.5 years time frame.
Right, sir. So just a follow-up on that front, last year was not very encouraging in terms of some of the key applications that these FDAs are used. For example, auto. You also mentioned earlier that you might have lost some of the volumes and your growth could have been a little higher than what could have happened in saner times. Sir, now these that we are trying to introduce, maybe we will get back to the normal level of growth, maybe once there's a normalization of this COVID pandemic. But these new products, how is the acceptance? I mean, how much time does it take for them to accept it so that we can start building up in terms of volumes, and we can expect a decent bit of growth happening in the early few years, or maybe and basically what I'm trying to seek is how is the ramp up of those you can see over maybe next 2, 3 years, 5 years of the new products, I mean.
Excuse me, this is the operator. Participants, the line for the management is dropped. We have reconnected.
Yeah, sorry, the line is getting disconnected. Really sorry about this. Sorry, please go ahead with your question, sir.
Yeah, sir. So I was asking, now that you mentioned earlier in one of your comments that FY21 probably could have been a better year because some of the products could have been going into key applications like autos. They must have seen a higher volume growth. So let's consider that. Let's say that your volumes in those brackets would probably come back to normal. But what about the new products, or how is the acceptance that you see going ahead, maybe 3 years, 5 years down the line? How much time do they take to accept your new product and try and apply it in different other segments or in auto for that matter? So how can we see growth happening on the new product side?
So see, this is an ongoing continuous process, right? So this process got little bit delayed or got derailed during the COVID times, where even the R&D teams of our customers were not able to work from there. They had to work from home. So most of this approval processes had almost come to a standstill. But I believe since November of last year, so November of 2020, things have been back on track. So of course, some of the the approvals which we were expecting to happen in this year probably are delayed by almost a 6-month time frame. But in terms of demand, the existing demand of the products, it has been back on track since November of last year. And this approval process is an ongoing process, and as I explained in one of the earlier questions, this is a strong entry barrier area where typically it's a 2-year to 6-year time frame where you get approvals and you see a commercialization happening.
Right. Okay. Thank you. Thank you, sir. Thanks a lot.
Thank you.
Thank you. Participants, to ask a question, please press star, then 1. Anyone who wishes to ask questions, please press star, then 1. Participants, to ask a question, please press star, then 1. The next question is from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for this opportunity. Sir, just one question from my side. What type of order book are we carrying in hand as on date?
As I told you, we typically have a good order book for next 6 months time. So up to December, we have a visibility because that is the way this system works, So you get those kind of orders probably 3 or 4 months in advance where you are able to execute them on time. Because most of these SDAs or certain of the products where we are predominantly into export, so the lead time to the customer is also quite high. Whereas, this whole system typically works in terms of forecast system. So in terms of order books, I would say we have a good decent order book for the next up to December.
Okay.
That is the visibility.
Okay, sir. And sir, on the margin side, you have mentioned that you have a decent visibility on the margin, though some variations might be there, but it should be a good number. So just wanted to check from the current level or the margins of the current quarter, do you see our margin expansion from these levels as well, or on a sustainable basis, these would be the current quarter's margin would be sustainable?
See, as earlier also in one of the questions I told that we are into variety of product segments and number of products in each individual segments, which each of them have a different variety of margins. So it is usually very difficult to gauge us in terms of quarter-on-quarter basis. It's always because the product mix keeps on changing. This you can even observe from our past 1 year or 2 years. Each quarters you may see there is a different product mix that keeps on happening. So based on what product mix we are able to sell, the margins may vary plus or minus. But I think we are more or less in the range where we expect that these are such.
Okay. No, actually, what I wanted to check was, say, if I look from next few years time frame, say 2 to 3 years time frame. So currently we are at 24% margin level. Do you see the sustainable margin to be at 24% or say 26, 27 odd % type of thing? So
I would say I would rather prefer to choose a range rather than picking up a specific number. I would say a plus or minus 2% range, let us say from 23 to 27 or 28% margins is what I would like to choose. Again, this going forward when you are asking in terms of 3 to 5 years of a range, I would say, the things that we are doing in R&D, if things click up well and we are into a better segments or better efficient products or a very niche segments, then this can expand. So it all depends on how successful we are in terms of developing the products. Though we are very hopeful that we are doing a very good job when we are talking of developing new products or developing newer technologies. So, but probably I don't have a very clear and a very precise answer to this, but I would say a margin range of EBITDA of 23 to 27, 28% is what I would presume is pretty much sustainable.
That's quite helpful, sir. Thank you so much.
Right.
Thank you. The next question is from the line of Dhruv from HDFC Asset Management. Please go ahead.
Yeah, sir. Thank you so much, sir. Sir, relatively a smaller thing, but sir, the interest cost seems a significant increase on a QQ basis and even on a YOY basis. Is there some abnormal there?
No, see, basically, we were into this IPO mode. So a lot of our surplus funds got drawn into meeting with those ongoing heavy expenditures in terms of IPO expenses. Also, if you see our numbers, in last 5 or 6 months, so right from January quarter, so January to March and then again this quarter, there is a very significant sudden growth in terms of sales. So that has also caused us expand our inventories. Also, our debtor collections has shot up because of very high increased sales. So this has caused us to use larger amount of our working capital cycle. Now, once we have sold the product, started selling higher volumes from January onwards, and the realizations have started to kick in, we feel that again, we will. So this is probably a temporary phenomena where 2 factors coincided. One is the IPO expenses for which our surplus cash got drawn into, and secondly, increased revenues, a significant increased revenue if you see. So because of that, our working capital requirement shot up drastically. So this is probably the reason why you are seeing an increased outflow in terms of interest.
Got it. And so similarly, there is an increase in the other income also. Again, it seems something one-off, but if you can help us.
Yeah, so this is basically coming from the export benefits. You have those duty drawbacks and stuff like that. And but I think precisely this answer can be given by Mahesh Bhai. But this is predominantly coming from foreign currency fluctuations, export benefits, and in terms of our revenues that have shot up. So this is also proportionately going up.
Okay. Got it. So this can probably continue on a higher level. So just one thing from your previous answer. So is there a significant difference in terms of the working capital cycle? When I say working capital cycle, including the inventory, the purchases you make and the suppliers that you pay, between our SDA business and a non-SDA business? Part of it is, of course, forward integrated. So I'm unsure how we can explain it.
No, I would say this is a very good question. Because, see, what happens in SDA, particularly, SDAs and electrolyte salts, are particularly two segments where customers also produces on kind of campaign basis, So they have multiple suppliers for the same product. So when they are running the product using my raw material, my demands may shoot up and then again come down to a little lower levels when they start using the competitor's product. So because of this, so what happens that there may be a lean phase, but we continue to produce so that when the uptick comes, we are able to meet their delivery demands because a large quantum is ordered at a very short span of time. So this is virtually impossible to meet from a zero inventory level. So to cater to this kind of a typical business nature, so at times you may see a larger inventories because we are continuously producing but not selling for a few weeks, and then suddenly the demand sets in, and then we are able to meet those short-term demands, short lead time demands that comes up. So this is a typical nature of the business. And with increased forecast that we had, so that was bound to happen that our inventories were going to be piled up. Otherwise, we would never be able to meet with the delivery schedules of the customers.
Okay, got it. That's helpful. And sir, you mentioned that you typically get a relatively an annual forecast from your customers that approximately this is the volume that I would be demanding. And is it fair to understand, so this is the annual broad number, and on a moving basis, they keep giving you, say, a 3-month target or a, say, 2-month number, that this is the actual quantity that I want. Is that how it functions?
Right, absolutely, yeah. So basically a quarter in advance is what it works because typically it takes about 4 to 5 weeks as the lead time from shipment from our factory to customer's factory, 5 or 6 weeks. So typically it's a quarter advance intimations that we get about the potential demands, and they start placing orders accordingly.
So an annual number to plan yourself better, and then a quarterly forecast for the delivery schedules.
Precisely.
Got it, sir. That's very helpful. Thank you, sir.
Thank you. The next question is from the line of Neeraj Runtla from Mega Profits Consulting. Please go ahead.
Hi, sir. Congratulations on the good set of numbers. Am I audible?
Yeah. Go ahead, please.
Okay. Thank you. So, in the news, we have heard something about supercapacitor batteries being manufactured in India in maybe next 5 years by Reliance in joint venture with Ambri. Does the product which you manufacture go into these or it does not?
Right. So when you talk of supercapacitors, so each supercapacitor would require an electrolyte solution to feed into that. So this is where we are into. So this is exactly the chemistries and the electrolyte salts what we produce are going into applications of supercapacitor batteries. So yes, we are into those similar kind of product ranges.
So, may I ask you then, currently for electrolyte salts, you don't have any customers in India as of now?
That's true. Yeah.
So, going forward, when in India, let's say Mr. Modi highlighted yesterday regarding the clean mission which he has, so we would have ample number of opportunities for the chemicals which you manufacture to be used in India, to be supplied maybe in collaboration to, let's say, companies in Europe or let's say, to produce hydrogen. So would that be a fair assumption?
I think that's an assumption, but I am also equally optimistic as you sound today. So this is what we also expect to happen, and I hope it happens sooner than later.
Yeah, that's about what I wanted to ask.
And that is why, see, particularly despite of electrolyte salts just having about 1 or 2% of our overall revenues, we still continue to show it as a separate segment and not merge it into specialty chemical segment. So this is precisely the reason where we feel this is a kind of a destructive technology that is coming up in terms of energy storage devices. And we are also equally optimistic as you sound, and we hope for the best to come in the near future.
So may I ask you, maybe in your presumption, how much is the horizon should we look at for a better understanding of, let's say, your complete utilization of electrolyte salts which you will be manufacturing? Maybe 3 years, 4 years, 5 years down the line?
I would say 4 to 5 years would be a fair, though, most of this segment, supercapacitors already, China is growing very rapidly, and our products are very well accepted into this market also. So probably supercapacitor end use may not be in China, it may be elsewhere in the world, but most of the supercapacitor production as of today is coming out from China and Korea. So those are the tough markets to crack or to be into, but we are pretty much successful in pushing our electrolyte salts and gaining popularity in terms of acceptance, in terms of good quality. So, but I'm not very sure probably whether 1 or 2 years down the line you may see